All right, so we should be live then.
Yeah.
We should be live. So welcome everyone to the stream. I thought I'd do a little live stream on a Sunday, and we actually did one of these streams on Jay's channel. So link in the description with Jay's and John's YouTube channels, because they both got YouTube channels. And then we've got Will and Jordan. We're just a big group that literally talk about stocks, and we're obsessed with stocks. And I thought we'll get everyone on and we'll just have a talk really about stocks and everything. And I thought a good one to talk about as well, because of we're going into a new year. Obviously, it's hard to say what's going to happen. No one knows exactly. And you obviously get the typical comment saying, are we going to go and have a correction? Are we going to be in a stock market crash, or is it going to be green? You just don't, no one actually knows. But I thought it'd be important to just talk about bear markets really, because they do actually happen, obviously. And people that are new to the stock market last year now, I was going to say this year, but last year would have obviously had a really good time, especially the last few months. So yeah, I thought it'd be important to talk about that, and then we can see what everyone does, how do they deal with it. And yeah, obviously there's some big events happened with obviously America and what's happened there, which we could probably touch on as well. So yeah, but the first thing, Jay, did you have some little bits or not?
No, I'm still finding them, so we'll come back to that. So I'm just finding them still now.
Yeah, that's all good. So what I'm going to do is I'm going to show on screen this tweet, which I thought was really interesting as well. So if I go on to just sharing my screen. All right, so can everyone see this on my screen?
No, you need to press it in the bottom. On the bottom bar, you'll see the screen. You need to click it and it will show you screen. You see where all our faces are and stuff?
Yeah.
It should be, there you go.
So as you can see here, this is where I need a two screen setup. But as you can see here, it shows you how many times the S&P 500 has corrected, and also how much it's gone up. So it's only gone up. It's only gone down more than 40% once since 1928 to 2025, and two times between 40% and 30% down. So it's obviously it doesn't happen often, and obviously we get more green days than we do red, and it's just important. If you want, you can pause this, have a look at it as well, and see how often it comes around and all that. But obviously the big thing as well is patience and timing. So if I go back off screen, I just want to talk to everyone about what's their thoughts, and yeah, when it does happen, what do you guys do? Because yeah, it'd be interesting to know.
Who wants to touch on it first? George, do you want to go across the line? What's the plan? If you go
sure,
across the line,
I'll jump in. I think I'll cheat and answer a little bit in terms of what I prepare before a bear market happens. I think in terms of the mindset, I think it's good to have around being able to weather a bear market and expect those to come and be able to be prepared for them. I think it's not about timing, sort of predicting when a bear market is going to happen and when a crash is going to happen and changing everything before that. I don't think you can really you can get lucky, you can have some good estimates, you can have a range of when you think something like to happen, but in terms of timing it, I don't think it's as important as having a right mindset to be able to go through a bear market. And I think there's various things that come under that. There's just doing a little bit of a risk audit of yourself. So sort of as you just showed on that graph, Ben, what type of years can happen, albeit it's nice to see it's much more heavy on the green side than the red. And I think there was only 11 years since 1928 that have been more than 10% down throughout the year. But looking at those, so looking at let's say next year was a minus 10%. Are you comfortable with what you've got now going down 10% and not panicking, not feeling any sort of strong emotions through it? And if not, then there's something to change there before those bear markets even come around. So you can do a little risk audit in that sense. What I like to do is I like to have a bit of dry powder, a bit of cash on the side to make the most of opportunities to turn bear markets into something good in terms of buying into stuff that maybe I've been watching, maybe I like already, and then they're going to sell off even cheaper. And then I can make the most of that. I know it's not everyone's thing. Some people like to be 100% invested, but I like to have a little bit of cash. So when those opportunities come, to make the most of them and to snap them up, and then it makes a bear market not all bad.
This is another question as well. Like because obviously you saying, yeah, keep some cash on the side. And I just thought of something that gets asked all the time is, let's say someone's got, obviously we're not financial advisors, by the way, guys, like this is just what we've done. We're not saying we're experts either, but I want to ask this question because I think it's quite an interesting one is, let's say someone's not touched the stock market before and they've got 10 grand. Do they put that 10 grand straight away in? Or so would you put in 10 grand straight away, or would you put in, let's say, £2,000 a month and average in, or would you put the lump sum in? Because that's quite an interesting one to ask.
So I think that's personal preference on affordability and stuff as well, because some of us in April will fully load out our ISAs, and then other people divide it down and don't max their ISAs throughout the year. So I guess that's just a personal preference, because I mean, myself, I'll put my full ISA in April, but I don't necessarily disperse all that cash straight away. So I guess that's personal preference. We're going back to your question about the bear market preparation. I think you can just make preparations for that, like Jordan said, in a normal market sense. Like, for instance, being 10% cash, like cash is, it's one of them people's preferences. People don't like to hold cash, but you don't necessarily need to be in a bear market to see 20% drops, 30% drops. That can happen, especially when in the stocks that us guys type of hold, in regards to Oscar, Ondas, SoFi. Like we've seen it in AMD, we've seen it on Palantir, we've seen it all across the way this year. So I think, and we're in a bull market, so I think being slightly cash and having, like Jordan said, some dry powder really makes a difference.
Yeah.
You up, Will?
I think that during the general kind of green times is the time to kind of really really build those habits. You know, are you putting in money every 2 weeks? Are you doing it every week? Are you doing it every 4 weeks, every month? But just being consistent, because when you get to a bear market, when you get to a difficult period, that's when the psychology really comes into play. But if you just keep doing what you've always been doing, it should then be, it's kind of easy to carry on because it's been a habit before. Yeah, and if you do have a bit of extra cash, you can put more in during that time. But I do think it's important to distinguish that when we looked at that picture, and when we're talking about bear markets, there's sort of like two different things slightly going on. There's like the whole market. So like the S&P 500 is generally what we mean when we talk about the market. But then there's individual stocks. So if the S&P drops 10% over the course of the next 2 months, there's going to be stocks we hold, as kind of Jay said as well, which they are high beta, and high beta means high volatility. The volatility of high beta is larger than the beta of the S&P 500 of the market. So you also need to be prepared for, say, like a fairly expensive stock, let's say like maybe like a Robinhood. Will it get a re-rating during a sustained market dip? If the market dips 10%, Robinhood's going down 40-50%. It's going to get re-rated because the valuation it's at now isn't going to sustain during a whole market sell-off. Doesn't mean it's a bad company. I'm sure the earnings will still be great. I'm sure it'll be growing really, really well, but it's going to drop down a lot. But that isn't necessarily a bad thing. It depends on your average, and it depends whether you buy into that downturn, because generally the market is green more than it is red, but the red is the opportunity. And obviously everyone knows that famous Warren Buffett quote about being fearful when others are euphoric, and obviously vice versa. And that's broadly what I'm kind of saying is keep the habits, keep buying every month if you're buying like an index. But if you are buying high beta stocks, then be prepared for the valuation to change. But overall, I would say that's a time to buy if you have conviction, if they're good stocks, if they're growing, and if the earnings are still there.
it's interesting you say that as well, because I looked at something the other day because I was actually like I wonder what the like PE ratio was of like, I don't know, one of the big companies like Meta, for example. So in 2022, when it was that like year bear market where it was just constant red days, the lowest Meta got to as a PE ratio, it was at 11 or 12. So 11 or 12 was the PE for Meta at the time, which is mad to think, because obviously when everyone talks, like the standard for, I would say, a company like that, they say between 20 and 30, right? So the fact that it went all the way to 11 is mental, and it's like, it just shows you like how valuations just change and how much someone's willing to pay at the time in a bear market. So yeah.
I do think, looking back at the 2022 tech wreck, there were just some obvious buys, but I guess when you're in that moment, you know, you've had 6-9 months of red, everything's going down. You don't necessarily think, oh well, Meta's 11 PE, it must be a good buy. Obviously, if you've done your homework, hopefully you will. But yeah, it is like, I do think you make a good point there, Ben. But sort of looking back, you think, wow, like there were some really good opportunities there.
Yeah, no, 100%. Well, that's the thing. It's like, this is the thing I find interesting as well, is like, obviously people have got, they say obviously if the PEG ratio is under 1, it's normally a good buy. Same with like a PE ratio. If they're a tech company, and they're trading below 20, it's normally a good buy. And it's like, obviously that's someone saying those valuations, and it's like, at the time, like, yeah, for it to be 11 PE, it's like no one wanted. It's almost like people weren't wanting to pay for the company at a bigger premium. It's just, it's just interesting how like bear markets work, and how obviously in a bull market everything's just almost like triple the price, almost like how much what people are willing to pay for it. But yeah,
what's your views on it, John?
I think it was Jordan that said it's about your habits. I might have been Will. I think even through a bear market, you've got to maintain the habits that you've built during the bull market. And I will always go back to my research. If a stock looks like it's taking a big hit, then you should do the same in a bear market, because you'll know whether you're in a bear or a bull if your thesis is still correct. Obviously, it's harder for companies that are, burning through cash and everything. But yeah, I think it's just maintaining those habits. And if you can spot a bear market coming, so like this last year, I've never held cash, but I'm expecting a bit more macro uncertainty next year. So I'm going to start holding a bit of cash back every month when I do my monthly deposit, and just have a bit of cash on the side, like the others have said. But for me, it's just remaining emotionless, keeping those habits that you've built up during the bull market. So you even it out really, and just go back to your thesis.
Yeah.
No, I think that's fair. And I like, so obviously we're on this topic of bear market for a reason. Obviously we've seen what's going on with Venezuela. We're seeing what's going on in subsidies at the end of the month and stuff. I have got that clip now, so I'll show that in a minute, Ben. And obviously we're talking on stuff like that's why it's important, because I guess January, how do people agree on this? Do you agree that January sets the tone for the year? What's everybody's thought on that?
I think, do you know what's interesting is like the psychological side to things with stocks is now the fact that obviously it's a new year, the year to dates will be, obviously it was set to 0 when it was the first, but now they've all got new year to dates, and it's like psychologically it's almost like you're on like a fresh slate. Obviously valuations is obviously the thing that keeps them where they are, where they're meant to be in time. But yeah, like I think, it's really hard to say, but because things happen throughout the year. But obviously a lot of tax harvesting happened a few weeks back, so some stocks got hit quite hard, or not hard, but near the end some were selling off. But yeah, I think, it's hard to want to say.
The reason I asked that question is because, I don't know if I say it right, the Kowasebi letter, or however you say it, shared a statistic earlier that for 76% of every single time of January has been negative. The rest of the year has been negative, or it's something across those lines. I'll have to find the exact tweet of what it was. So if January was a negative month, 76% of the time it was a negative year, or it was vice versa. If January was a good month, 76% of the time it was a good year, which I think was the stat that I seen. So,
Yeah,
I guess
like,
January
I think it is. I think it's like a psychological. I know this sounds ridiculous to say, but it's almost like a human psychological thing. Like if there's like the year to date for the stock start off good, it's almost like it will be good. And obviously going from them stats, it's interesting to know that if January, let's say, is green, then there's a 73% chance that the whole year will be green, and then vice versa. So but we will see.
You want to, because you're obviously invested in Oscar and stuff, Ben, I know a lot of your followers are. Do you want to share the screen and then we'll touch on this thing and then we can move on that? If you want to, hold on, let me just share this. Share screen. Window. There we go. There you go, if you want to share that. Do click that screen. So, we'll watch this real.
Agenda for the new year. Emily Wilkins joins us with a look at what I'm assuming
This
is
was
a
from
very
last week.
busy to-do list. Emily.
Hey, Leslie. Well, look, the first things Congress needs to do as soon as they get back is to avoid a partial government shutdown. Remember, government funding runs out for most of the government on January 30th. Now, lawmakers had hoped to make some more progress. They wanted to move these 5 spending bills that would have covered a majority of government funding, but a number of conflicts are holding up that package. However, several Democratic lawmakers, including Senator Peter Welch, told us before they left town that they don't expect another shutdown this time around.
It's a different time frame.
Okay, so going off that, you can take it off now, Ben, because it just waffles for about another 2 minutes. So obviously, what's everyone's thoughts on that? Because that's going to affect your type of stocks in regards to stocks like Oscar and stuff in it, Ben.
Yeah, no, obviously I've said before, obviously if the enhanced subsidies did get extended, then obviously Oscar will benefit massively from that. And obviously it's good for the business. And obviously if it does get taken away, which it does look very likely it's going to be, then obviously it's not good for the business and it loses out about 7%. So the enhanced subsidies counter for 7%, which is the higher tax payers. So they'll lose out on the subsidies, which obviously, yes, that 7%, it is a lot, but in the grand scheme of things, it's I just don't think it's going to hurt Oscar as much as what people are saying it's going to. And like I say all the time is and it goes back to really looking at their track record over the years, over the earnings, and if you can trust the CEO. And I mean, the CEO keeps saying as well, they're going off the fact that they're not going to be extended. So they've obviously given out their guidance of what they think. And obviously they're confident that even now, well, we're in 2026 now, so it'll be interesting to see, but that they are going to be profitable in 2026. And then 2027 is when you'll start seeing more of the EPS growth coming in. But yeah, no, it is an interesting one because obviously, and I think it goes back to a lot of headlines can get almost overdone and people overreact sometimes with certain headlines. And if you kind of delve more deeper into some of the numbers and the graphs that I've been looking at, it's not as bad as what people think it is, to be fair. And how they're steering away their business model as well, so they're not so reliant on it. But I mean, yeah, it's going to be an interesting one, isn't it? 31st of January.
Yeah, so there is only on the poly markets, there is only a 25%. And I don't personally, I was talking to somebody else who was quite clued up in the US, and there was a big scandal, wasn't there, in Louisiana or something with all the daycare centers. So I think there's a big thing going on there. So I don't think there'll be a big shutdown. But what's everybody else's thoughts, George, Will, John? Do you think there'll be a shutdown, or what's your thoughts on that agenda?
I haven't seen too much about it, to be fair. I think it's possible, but I think now with the prediction markets, they're so good, and I think it's about 25%. It is trending down. I would say I'm going to trust that. I'm not massively repositioning really because of that. I know that in the end the last shutdown wasn't great, but I think that was more to do with the massive crypto liquidation on the 10th of October. So no, I think we should be okay this time. Like it might be a bit a rocky through January, but I think we should be fine on this front, hopefully.
I think there's a chance it can still happen. Because if you look at the predictor markets when the Fed rate cut was coming, that was swinging for several weeks. I wouldn't be surprised if it happens, but I think the sentiment around it is a lot more positive than last time. And if it does happen, I don't think it'll happen for as long as it did last time. So even if it does happen, I don't think the effect will be as big as the last one was. So I wouldn't be surprised, but you never know.
Yeah, I'd agree.
It's the midterms this year, and I think both parties want a fairly good year. I guess the Democrats don't want an amazing year, but they still want to look good. So neither party is going to want to be coming out bad and being blamed for causing the shutdown. There's lots of talk about how, like, the general cost of goods. Both parties are talking about the general level of inflation, the price of gas, groceries, etc. I just don't think it's a good look if they're then shutting the government again. Millions of workers aren't getting paid in a year when the Republicans really want to win the votes, which are towards the end of the year. So I just don't think either party wants it this time.
No, I think that's agreed. I think that's probably, like you say, the best take on it, to be fair. You've probably hit
What's
the
your
nail on the
thoughts
head.
on, like, the situation that's happened, obviously, recently with what America's done? What's your thoughts on that?
In regards to what, sorry, Venezuela?
Yeah.
Oh, God.
Because they're
You're
a massive...
reaching into politics now, Ben.
They've got all the oil. Like, it's mental. So America...
Are you talking about what it's going to do for the markets? Is that what you mean?
Yeah, like, because they've got all the oil in the world now, America.
Yeah, it's a tricky one. I mean, I was watching crypto because obviously Bitcoin's going to be something that you'd like to see that moves with that. So, and to be fair, it actually went up a little bit and it's actually stabilized above 91k, which is the first Sunday in many Sundays where it hasn't fluctuated on a £1,000 scale. So obviously that's a bit of an optimistic mindset to say that the markets will open higher. That's my take on it, but I don't know if that'll be correct. We'll find out at 11 o'clock, see what the features are like.
This sort of a massive event gave me like a good chance to just have a look at oil, have a look at kind of like how it works. And yeah, even though the US in theory will then have access to the world's largest oil fields, it's just nowhere near as simple as that. Like, it's going to cost 40, 50, 60, 70 billion dollars to kind of build up the infrastructure to actually start getting the oil out. So I've been looking at what people are saying, looking at kind of people who know a lot about this industry, and it's going to take a lot of money and a lot of time. Like, it's not suddenly going to start ramping up production because their general oil, like their kind of production facilities are quite out of date. They're barely producing any oil, especially in comparison to how much they've actually got. So if kind of everything goes well and the American companies can get in there, it might be about 10 years until they're probably actually producing a large amount of oil. And already there's a bit of a surplus, and that's why prices are so low for oil. So I can't see them wanting just to pump out like excessive amounts because other countries will then just start producing less. And also, just one more thing: if these private companies go in there, Shell, Exxon, etc., they need the money. Like these companies haven't got 20, 30 billion just lying around, so they need they need billions for their capex to build up the infrastructure. So I think it's like a big geopolitical thing. I think it's going to affect relations with the US and China, with maybe like the US and Russia. I think it's reasserted for the US in like the Western Hemisphere. But in terms of like all in the markets, I'm actually starting to lean towards that it's not going to have a massive effect.
Because this is the thing. This is what I'm interested how the market's going to react to this on, well, the futures and obviously tomorrow. Because and the other thing is as well, which a lot of people were like almost, I don't know how to word it, but like celebrating in the sense of like a lot of people think there's like a 90% chance that Palantir was involved with how quick it happened. Like, because Russia with the whole with Ukraine, like obviously that's been going on, but the fact that America did it, how they did it was so seamlessly, it was mental. And a lot of people are saying Palantir probably had a massive involvement in it. Who knows? But that's obviously a different question and a different conversation. But yeah, it'd be interesting to see how well the market reacts to all of this, to be honest. But I thought I'd just mention it.
I've just thought back to something last year, and I've got a question. It's a bit, skeptical, but how long do you think they've been planning this for? Because I've just remembered, and I found it, that Chevron's US license to operate in Venezuela expired in May last year. And obviously Chevron will probably be one of the bigger ones. So how long do you think they've been planning this for? And do you think this is an easy way for licenses to get renewed for American companies to drill more oil?
Again, without getting too much into politics, because I CBA with it, it's a lot more to do with the petrodollar. It's a lot more to do with energy. It's a lot more to do with thick oil. It's a lot more to do with drugs. It's a lot more to do. There's so many spider webs from it, but
yeah,
I don't touch in politics. It's our my boat. I'd rather just stick to watching the stock market. I watch the news for what I need to watch, but I try to not to have. The problem is when you start getting into politics, there's too many opinions. You're always going to upset someone. I mean, I'm looking in the I'm looking in the comments now, and I'm already seeing people saying stealing other countries things, nothing to be proud of.
No, I know exactly. Like this is the thing. Like it's just too many controversial points and things like that. And it's even like the thing that one thing before we move on is like the White House was tweeting out and just like doing almost like a little meme montage of like how amazing it was in the sense of like how they just captured him, and it's just like I can't believe like the White House has tweeted that. It looked like
it's a bit of a catch-22 as well, because I spent a few hours yesterday watching Venezuelan TV, and there's hundreds of thousands of people in the streets celebrating it. But of course, you've also got thousands of people upset about it, and this is where your divide comes with politics. So you've got a lot of people that feel free and they're looking forward to things that are going to happen in their country, etc. But then you've also got half that are very divided because they obviously respected their prime minister, respect their country, they feel invaded. So again, that's why where I say some people, you're never going to please 100% of the masses. It's just impossible. So you can literally rebuild a homeless center, but if you do it in the wrong location, someone's always going to get upset about it. So you know what I mean? You're never going to please the masses.
I'll show you this quick because I just literally can't believe this even got put out there, to be fair, but I don't know. I'm hoping you'll be able to hear this, so let me just.
You'll have to share your screen again.
So if I play it, we'll hear, right?
Yeah, you'll play it, you'll hear it, yeah.
Venga por mí. Aquí lo espero en Miraflores. No se tarde en llegar, cobarde.
And now, if you don't know, now you know.
Like the fact that the White House tweeted that, I can't believe the world we're in. Like,
like someone just said in the comments. Oh, someone just said in the comments, can Trump come do the same here in the UK? I'd take Trump as the Prime Minister though in the UK. Our Prime Minister's crazy. It's criminal.
Yeah, and there's another thing I want to show. Nothing to do with politics now, so don't worry.
Ben's trying to get himself cancelled.
Yeah.
I know drag me down with you.
Controversial stock anyway. So
I get enough people writing bad shit about me on Reddit as it is. I don't need anything else.
All right, I'm gonna play this clip as well.
You're old, you are, Ben.
This one here.
So
I ain't seen this one. I ain't seen this, to be fair.
what's the timeline on that correction then? If you were to gaze into your crystal ball,
I think we're going to reach a moment in the next year where the conversation will shift from lower interest rates to rising rates, but it will be for a good reason. We think that the economy, the US and the rest of the world, of course, will participate, is going to move into a productivity-driven boom just in time for our midterm elections. So I think when interest rates reverse, there will be a shudder because there are a lot of people out there, and we saw this during COVID and its aftermath, who think that innovation and interest rates are inversely correlated. That is not true over history. Even in 2017, when interest rates went up, we had phenomenal performance. So I want to disabuse people of that notion, but nonetheless, the way algorithms work these days, we think that there will be a reality check, shall we say.
So she's pretty much saying, like, if I stop sharing. Does it stop sharing? Yeah, cool. I'll put it up as well. Hang on. Share screen.
I do think it's important to kind of take comments from like the wider people who are in this space with a pinch of salt.
100%.
Because like while I was listening to that, I was thinking, which is fair, but I was thinking, you're the first person I've heard talking about rising rates. Like the general consensus is that come May, come June, with the new Fed chair, he's going to probably lower rates by 0.5 to 1% on the first meeting, and then they're going to be sustained lower for the next 1, 2, 3 years, probably until Trump. Well, probably until Trump leaves. So yeah, obviously rates will rise at some point, and when they do, maybe we will have a 2022 style bear market tech wreck again. But as of right now, I can't see rates coming up anytime soon.
Yeah, I know, and that's why I wanted to like bring it up, because I just found it interesting when I was scrolling past and I saw it, and it's like, and it goes back to earlier when we were saying about obviously the stock market it's quite reactional with things, and obviously we're all anticipating interest rate cuts, and that is what's going down. But if it starts obviously having the conversations of rising, obviously the market could react quite bad from it. But yeah, and I just thought I'd mention it and see what people thought of it. And yeah, just found it interesting. Obviously, Cathie Wood as well is a controversial person anyway, with some of the stock picks she's had recently and the price targets she's had. So
allegedly.
Yeah. Oh, and look, yeah.
Allegedly. Just because someone's name's before it don't actually mean they're doing it. I see this all over Twitter all the time, and I see people loading into stocks because I see Congress people doing it, and 80% of the time the stocks don't even move. It's just because she called Palantir right. I mean, do you know what I mean? A few people did. That means if anything, like you say, that's sort of why a lot of people follow you as well, isn't it, though, Ben? And people started doing it to myself with Ondas. People start seeing you pick 1 or 2 good stocks, and they think you're a guru, so to speak.
This is the thing, and also as well, I remember a lot when you were looking at the ARK Invest, like you constantly were seeing her buy it, and then you'll see her like sell a big position in it, and it was just like when you like kind of look closely at it, it's like there's no point even looking at these transactions, because she was like, a lot of people would do with any investment fund really. It's just like you see a massive buy, and then you see this massive sell after a few months maybe, and it's like I just don't really pay attention to all that anymore. I used to more so, but yeah.
I think the problem is with that stuff as well. It's people like with Buffett as well. people seem to think people like Warren Buffett and Cathy and stuff like that are sat in their room on trading 2-on-2 with their laptops. It's not the case. They've got a team of hundreds of people and analysts and people working for them that make the decision. I mean, it's a little bit like Bobby Axelrod when you watched, if anyone's ever watched that program, Billion. It's the same thing. You got somebody who sits at the top who gets all the credit, and you got hundreds of employees that actually make the work and make the decisions. So, yeah, you got to be careful with this stuff on X. I had someone message me yesterday, actually today, a voice note saying, I've seen on Twitter that X is going, that Ondas is going to go to $100, and it's like, come on, man.
Yeah. I know.
Everyone's looking for the next Palantir, and that's the problem.
I was going to say earlier on the topic of bear markets, I think it's very easy in a bull market for a lot of people to suddenly become geniuses or look like geniuses. And I think the difference is when we come into a bear market, the really good investors and the really long-term successful ones, the ones that are able to preserve the wealth the best through a bear market, whether that be having cash on the side and able to make opportunities of it, or just having more resilient investments through a bear market. And I think that's where things really change, because as I say, in a bullish market, most people will look like amazing investors because it's just so much easier to look that way.
Yeah, I'll show you this as well, which I thought was crazy. When you're saying about that, this is how crazy, like how good Warren Buffett was. Oh, you can't enlarge anymore, but
yeah, click the image, Ben.
Oh, there you go. So yeah, Warren Buffett was so dominant that Berkshire Hathaway could plunge 99% and still have outperformed the S&P 500 since 1965, which is just crazy. Like his returns were mental over because that's the thing. It's like, it's not even, it was over multiple decades how good he was performing. So,
yeah, but again, like I say, Buffett's an absolute legend to the space. But again, it's about the team you have around you. Obviously, Buffett picked Coca-Cola and stuff, and he absolutely smashed it. And obviously, he has the final say on what gets invested. But there is a lot of people around these firms that are finding these stocks. I've seen Finance with Joe put in your chat here. She was fairly early on Tesla, which has been a winner so far. But she also invested a lot into Beyond Meats and geonomical stocks in 22, which is exactly the point. Some people, I know I watched a video on Buffett the other day. And have you ever seen a video about the worst investment he made?
Yeah,
which was the textiles company, which he bought that textiles company for, it ended up being millions and millions. Then that company just went under, and he ended up changing that company into Berkshire, which is what Berkshire is today.
Yeah.
So again, there's been a lot of losses across the board with these good people. There's no one single investor out there that's ever got 100% win rate. It's just not right. It's impossible.
Yeah, I think going back to this comment as well, like we are actually in such an interesting time with obviously this whole AI boom. But I actually had a look at this as well, this video that Paul's mentioning, and it's like the CEO of AMD said in September 2025 that we are 2 years into the 10-year cycle. What's your thoughts on that?
So Jensen is speaking this week at the CES conference. A little bit of it. I'm interested to see what he'll be saying, because he'll have a big input on January. But being 2 years into a 10-year cycle, how can somebody say we're in a 10-year cycle? Does that mean that the market's going to crash in 8 years? Is that what she's saying? Do you know what I mean? So you have to take, like you just said, you hit the nail on the head. You have to take everything with a pinch of salt. Like people like Lisa Su, yeah, I was just about to say that, people like that, they're all phenomenal CEOs and really good people in the companies. But you have to understand that these guys have to be bullish and they have to speak well, because their words actually affect the market. I think Jensen said something a couple of months ago, and he said he seemed a little bit bearish on it. And I feel like Nvidia dropped a few percent. Is that right, Will?
Yeah. But I also was going to say that I think it's one of those times when two things can be true at the same time. I think we are in a massive build-out cycle, but at the same time, that doesn't mean that the market's going to be up for 10 years. It just means that there's going to be a big cycle of build-out of everything to do with AI, batteries, full self-driving, robotics, everything we can think of, tons of compute. But in 2 years, there could be like a bear market. So it's one of those things where there are massive changes coming, but that doesn't mean that it's just non-stop growth.
I had a presentation from Microsoft at work a few months ago, and it was about the emergence of AI and past AI models and stuff. And the guy from Microsoft said that it's currently on a downwards curve in terms of the functions that they're finding out, and then it'll eventually go back up, and that's when it really kicks in, because that's where businesses try and find how to use it in the real world, how to make money, how to make sure it's profitable for their business. So like Will said, it might be here for the next 10 years, but in 3-4 years time we could have a bear market. A lot of these AI stocks don't do well because they might not be making the money yet. So yeah, it's interesting.
Yeah.
Ben, do you get messages like this all the time? Just got a message from someone and it says, what's the next company that stock is under £5 you think will double next year?
Oh yeah, it's to be fair, most of the time I have to I just not in a rude way, but I just ignore it because I know there's no point like just kind of responding because they're not in the position to get into individual stocks.
Yeah, Will told me yesterday I've got to stop helping everybody. He had a go at me. I'll tell everyone. But no, this is the problem. I think some people, and this is where it gets a little scary with stuff like that in bear markets and stuff like that, because some people are just so trying to make a quick dollar all the time. And I literally seen someone comment earlier when I was having a little scroll, and he bought Ondas in September for 10 a share. And then when it dropped down to 5, he panic sold and lost $5,000. And it's like, and I think obviously a lot of your followers as well, Ben, are a lot younger. Well, your age, I say a lot younger. You're only a couple of years younger, and I think a lot of that happens. And I think that's why it's really important to have conviction and really, even if you only invest in one company, it's really important to really understand that company. Because when we had the last government shutdown, and every stock started not plummeting, but a lot of stocks started falling down. Ondas plummeted; it went to 4.5. It halved in value. A lot of us in the Discord, a lot of us in the group and stuff like that they didn't even start like panicking or anything because we understood what we was holding. So obviously, but there was other people I've seen online that were all panicking and selling. It's really essential that you understand that what the company does, who runs it, what's their niche is this affecting their financials? Is it affecting them on a news basis? And once you start ticking all these things off and nothing's changed, like you've got really nothing to be worried about.
Yeah, no, 100%. And it literally goes back to the whole thing as well. Like, if you're in a stock and the share price was going well, whatever, or it's going down, it's like, well, is there a reason for it to go down? And then you have a look, if the financials are going down, then yes, there is a problem and maybe you should get out of that stock. But then that's where you, like you say, Jay, this is why it's important to do your research, always keep up to date with the stock that you're in, and also the financials, because at the end of the day, the stock will follow the financials. So if the financials aren't adding up or going the right way, then eventually the stock will go that way as well. So you got to be careful, because honestly, I would probably point out more TikTok out of all the social media platforms. They're the ones where it's quite worrying, actually. People just see someone go, oh, I'm going to get this stock, and then they go, cool, he's bought that stock, I'm going to buy it. And then, like we mentioned, a bear market or whatever, that will probably get hit hard massively. They'll start panicking, but maybe the financials are good, maybe they're not, but they probably haven't even looked at the financials. So, and I'll be honest, I didn't when I first got in. So you learn.
And that's what I mean. I think everybody gets to that point where when you first start off, you look for people who are doing the right stuff. You look for things, and that's why we got such a great community as well, because you have people who've been investing for a very long time. You have people who are investing for next to no time, and when you all come together, you can learn off each other, not copy each other. You know me, Ben. Everybody knows that I'm really against a copying and stuff, but I also think hedging against yourself is good as well. So you got covered calls, for instance, if you're into options and stuff. If you've got stocks, for instance, like Ondas, where they've run 100% so far, people like that have run 100%, trimming somebody, even if your PT is 55, 100, whatever. If you're 100% up in a year, you've just outperformed the S&P by like 84%. Like, don't be afraid to take some profit just because other people aren't doing it. Focus on what you're doing and stick to what you're doing. What's your thoughts on that, George, Will, John? What's your thoughts?
Yeah, well, over sort of like the last sort of 5-10 minutes talking about Kathy Wood, talking about just sort of generally, I do think that the main person who is going to manage your money the best and make the best decisions for you is yourself. And I think it's always really important to remember that the most important person is yourself. And yes, I think we all watch YouTube, we all watch TikTok, or we go on X, or we pick up things here and there, but we have to take those things and put it through our lens, because that's the most important thing. Like, that's the best thing we can do for ourselves. It's why are we investing? How long are we investing? How much money are we investing? Only we know those things, and through that lens, through those filters, then we can see things, I think, better. If we're investing for 20 to 35 years for retirement, it doesn't matter what the market does, especially if you're in like a broad market index fund. It just doesn't matter. Just keep buying. And I think all of us aren't really traders, are we? Like, I think, are we all long-term investors?
We've got long-term mindsets.
Yeah, exactly.
But that's the thing as well. And even when I get messages, and it's not hate, because obviously people are new and everyone learns, but they're like, oh, how do I get into trading? And for a start, that's the wrong term. Like, don't look at it as like trading, it's investing. And
I hate when people say that.
Yeah, but then a lot of people as well are like, almost like thinking you can put your money in for a few months and then take it out and profit. And like, you should really, I always kind of look at it in my head as like, I always say like at least minimum, if I'm going to be going into a stock, like a 5-year time horizon. Obviously that can change and can vary, because obviously sometimes you might genuinely need to get out because the stock is underperforming or not going to the thesis that you thought, or vice versa. But especially when it comes to like just the basics of like an S&P 500, then you want to really look at having your money in for at least 5 years to like ride out those short-term waves of like either an interest rate cut or interest rate hikes or whatever. Like, it will kind of smooth out those short-term volatility. But yeah,
I think what you just said's bang on. When you buy a stock, you should have the mentality that you're going to hold it for 5 to 10 years. It doesn't mean you're going to. It doesn't mean that you're going to hold that stock for 5 to 10 years, but it means that you shouldn't be buying a company with only a mindset for a long-term investment unless you are swing trading it. You should have it for a small mindset. For instance, Hive, for me, I've bought Hive, but I made it publicly clear, when I'm buying this, that it's more likely a 12-month hold for me. So that's not a long-term investment. That's more of a short-term, because I'm thinking about what's happening this year, and I'm going to see some recovery on Bitcoin. So again, if you are buying a really good stock that you're going to hold for a long time, you should have the mindset you're going to keep it 5 to 10 years. Even if something changes after 2 years, which makes you come out, or a year or whatever, you shouldn't be buying stuff with, I'm going to make 100% on this in 3 months. And I think that's what this year created. This year created a lot of unrealisticness, because these gains that we've made this year we're not doing that every year. It's just not happening. What's your thoughts on that, George? What's your thoughts?
I think it's so natural when you first start to think, right, I don't know anything about this. Let me just find someone that's doing well and just copy them, and then it will go well for me. And why wouldn't it? When I started, it was because someone in my family members did it, and they were mentioning it to me and talking about it, and that's where it came from. Thinking back to then, all I wanted that person to do would just send me, yeah, I think I would do this and this and this, and then I'd just be, yeah, cool, thanks, and just go and do that, the exact same thing. But it doesn't work. Copying someone directly does not work, because there's too many variables and differences between you and whoever you're trying to copy, that in the long term won't play out in your favor. And all right, short term, you may be able to just jump on a trade, investment, anything they've done, do the exact same, and then make roughly the same return if it goes well. And then you think, okay, this is successful. Let me just keep rinse and repeating this, and I'll go up. But eventually the differences will catch up, and they will make a big difference. And it's easier to, it's hard when you're new, I think, to foresee that. So it's part of the learning. And I think if you do have people around you who are more experienced, have gone through years of learning themselves, lean on that and use that and listen to what they're saying. I've said this loads. I think learning has a cost to it, and it's being able to accept and sort of appreciate that there is going to be a cost. And maybe it's your time, maybe it's a bit of money, maybe it's a little bit of not doing things in the most efficient way, but that's fine, because long term, if you make those learnings and you pick up those extra bits of knowledge or skills, you'll make that back in what you have learned. And I think you've got to be comfortable with having that cost, and don't try and cheat it or skip it by just copying someone else or just winging it and taking a risk that's not thought out, because it will ultimately catch up. And especially if you are doing things long term, which as everyone said, I think everyone should be, those differences will catch up to you. So just from the get-go, start off in the most sustainable and the right way. And as I say, listen and lean on those around you who have already gone through that thing, have already started themselves, and know exactly the sort of things that you're going to be thinking about and feeling.
Yeah. What's your views on that as well then, George? Like, what's your take on it? John, sorry. Too many names.
I think it goes back to what Paul said in the chat. Like everyone's investing is very individual, and when you start, you make loads of mistakes, and that's where you learn from it. I had a similar thing to Jordan. Is when I first started, I was sort of copy trading someone. I wasn't doing my own research. I was just reading their research. Wasn't looking into the fundamentals of a business, and just sort of taking what they said as gospel. I got lucky. I didn't lose any money. But when I look back, I was like, Jesus. Like, so I took a break. I looked back and I was like, a lot of things I did there was wrong. So yeah, and then I think you made the point before of people would buy a stock and you take the profits as it goes up, Jay. And you've got to think in the moment when you are going to sell a stock, you might sell it on DAS for $13, but in 4 weeks' time it could magically spike to 30. And you'll look back when it hits 30 and go, why didn't I just wait 3-4 weeks for it to hit that? But then you've got to think back in that moment when you sold that stock, was it right for you? Because only you know in the moment if it was right. And if you made the right choice in the moment, then you can't really complain about your actions. Sort of look back with pride because you've done the right thing. You haven't listened to someone, you've listened to your gut. Yeah.
And I think just the last thing to touch on is when it comes to copy trading. For instance, if I find Ben online now, or I find myself, or I find... or if I'm following any of you lads on social media, if I see, oh my days, Ben's made 50 grand on Palantir, 30 grand on SoFi, and this, that, and the other, and try and copy. The problem is the ship's already left and grown so much. And I did see this question asked the other day of whether Palantir was the buy. Now, we're not going to be buying Palantir at said level because of the average and stuff that you've got in it. But in regards to if it's still a buy, it might be a buy for somebody, because obviously if it goes to 200, 210, 250, whatever, and obviously there is still growth there. But it was like I was saying to someone this morning, when I got into Ondas at 179, let's say 2 to 10 is a 5x for me. Whereas if someone gets into Ondas now at 10 and gets a 20, that's a 2x. Very different perspectives as when someone got in and whether it's still worth. Now, I wouldn't then again now buy Ondas at 11 because I've been buying it at 2, 3, 4, 5, 6, and now I'm getting my values worth. Whereas I wouldn't see as much value buying in at 11 if it was only going to 20. Do you know what I mean?
There's a lot of nuance. Yeah, I think there's a lot of nuance, because I think even with expensive stocks, maybe even like a Palantir, in my personal opinion, and this is just for me, I think it's a buy under 160. I think it's going to be one of the most transformational companies over the next 10 years in the whole global stock market. And I'm happy to buy at that range. And I know I've missed when it was 7 to 150, right? But that's just on me. So I think these things are nuanced, and that's why it's really important to just ask questions, learn, as we keep saying. And just like a more general point on someone new coming to investing, I think it's almost like how I imagine it is, you sort of open the door of investing, and then you think that's kind of it. There's just one door, but it's such like a snowball. It's such a pigeonhole. Sorry, not a pigeonhole. I mean, it's such a rabbit hole of like you open one door and then there's like another door, and another door, and another door, and you keep going. But if you sort of stay like kind of up behind those first 1 or 2, 3 doors, you're sort of missing out on a lot of key information, which is key nuance to why someone does this or why you should do that. But if you keep opening those doors, keep going down the rabbit hole, eventually, I think it kind of gets easier. I guess with investing, there's never really a moment where someone says, right, I know everything, because I think even the absolute best investors would say that they definitely do not know everything. but it just gets easier. And so I think just kind of keep going, keep being curious, and just try and build that sense of responsibility for yourself as well.
Yeah, I think it's
I agree on that. And just a quick one before we move on from Palantir quickly while I get it. Firstly, make sure everyone likes the stream as well for Ben. Obviously, he's got everybody here tonight. There's over 90 people watching, so everyone show him some love and make sure you like his stream. And secondly, what I wanted to touch on with Palantir is we only know about Ondas because of Palantir. That's the actual thing. So Brad and Beast Beast and Kay were having an argument about Ondas in regards to it not having a purpose, etc., with it being linked to Palantir, which then caused Ben and Beast to have a look into Ondas, which then brought it into other people's light.
mad.
So once you start looking into a company realistically, because you haven't got to just look at now, I know Jordan invests in Google heavily. I look at Google's investments every quarter. Google invested heavily into ASTS, which is actually what made me look into ASTS, and I made a lot of money off them this year. So sometimes it's about really deep diving a certain company, understanding what they're investing in on their 13Fs, etc., understanding where their vision is, and then you can see something before somebody else sees it. Even if you miss that boat, you might find another boat. And I'm going to say this once more before I let Ben take back over his own stream. When you work, you go to work. You work for 40 hours a week, most people, maybe even more, and you do this a lot of time. So you spend like 160 hours on average a month at work. You then trade your time for money. Now, and then that money you'll go put into the market after doing 5 minutes of research. So you really have to understand how valuable your time is that you've swapped for that money. So if you're going to go to work for 40 hours for it, at least spend 10 hours looking into stocks properly. Do you know what I mean? That's something I always live by.
Yeah, it's interesting, this little topic bit as well, because like obviously the average I've got with Palantir, like I haven't bought since, and I've got a set price that I would probably enter, but like with SoFi and AMD, like I was buying more at $26 with SoFi, and it's like, yes, I was buying, I've got an average of 12 or whatever it was, and I bought at 17, I bought at 7, whatever it was. It's almost like in my head, you've got to like almost think like, let's say like a massive tower block, there's different floors, different levels to it. And it's almost like SoFi's now reached a different floor, a different level, because their earnings are now obviously producing more. They're producing more. So they're now on to the next stage, the next level. And they've got so much more future growth to come as well. It's not like the company's slowing down. So there's so many more levels to climb. And it's like, that's why I'm almost happy to buy more SoFi and average up, which I know some people don't do, some people do, but I don't mind averaging up with certain companies, because I think the TAM, there's still a lot more opportunity to certain stocks that I hold. So same with Palantir. Obviously Palantir is a bit of a hard one mentally to buy, but I would, obviously Will said about 160, I think he said, dollars. I mean, yeah, if Palantir ever had like a serious crash that, I mean, people have been waiting for a while now, it could happen obviously easily well, going back to the stream earlier when we were saying about a crash, then yeah, I would seriously take advantage of it, because obviously the valuation would probably cut in half if we're in a bear market, and that's when I'll strike and take advantage of it. But yeah, like with any certain stocks, I would average up, to be fair, and that's what I've done with AMD and SoFi actually. So yeah.
And then, so same with touching back on that as well, Jordan. It's like yourself. I know you were singing and dancing about Google when it was 165, and a lot of people were saying it was going down the pan. A lot of people, obviously, when Apple had said that they were splitting away from it or whatever it was, and a lot of people said it was going down the pan, and you still believed about it. You put a lot of facts out there. Some people listened, did their own due diligence, and then got in as well. And some people didn't listen, like me, and missed that boat. So, what's your thought on that as well?
Yeah, I mean, I was averaging up on Google. I bought Google the whole way before their antitrust case. When it went in their favor, I still bought after that, and when they had good earnings, I still bought after that. I'm not lumping in too much now because my position's at a nice size and I like it as it is, and not too much as a overall percentage of the portfolio, not too heavy weighting, but it's not a lack of adding because of a change of sentiment. Yeah, I mean, like same as Ben. I was happy to keep buying above my average. I was happy to keep accumulating more, and I was happy to keep adding the cash that I did have straight back into it. I think it's a reflection of your conviction in your picks and your investments and what you're following in. I'm not saying that everything that you like you have to keep adding to all the time. You have to always average up, but I think it does when you're happy to and you're confident to. It reflects the confidence that you have in your own due diligence, in your own research, and that you have done ample of it to feel confident and feel able to do that. Yeah, I know some people don't like the averaging up because they focus so much on their share price average and they sort of almost protect that as if it is the most important thing. But as a few other guys have said in the community, that ultimately sometimes the better priority is to have as many shares as possible in what you like, rather than having the shares at the lowest possible average. Number of shares is more impactful to you.
Like Dan Ives said as well, like a lot of people missed out on Amazon, Apple, Microsoft, all Google, like a lot of these tech companies, because they were considered overvalued, and they were always overvalued. They would never like almost valued well. So no one would ever want to strike and buy the stock because it was always considered overvalued. But there was a reason for it, because they were special companies. And sometimes with special companies, they do, I know it sounds cliche, but probably command like a higher PE because the amount of growth and the opportunity the market can have. And Amazon were always, well, getting better, coming up with new products, new services, and they're always expanding. And it's like, that's why you got to keep an eye on the earnings calls and the company that you're in. Like, are they always evolving? Because then, I mean, if you're in a stock like that, then it's always probably, you can always keep averaging up, and it's just, that's the thing as well. A lot of people sometimes find it hard to maybe pay, like, it'll probably be overpriced, but in the future it will look cheap, and sometimes you can miss opportunities as well.
Sure. I'm watching Amazon quite closely, actually, mostly from a TA side, if it comes back down to its 200 moving average, but I do like the look of Amazon at the moment for sure.
Ben,
Yeah.
I think Ben's just put a comment in the chat. I don't know if you want to flag it real quick, the Ben Fleetwood. I'm going to have to jump off in a moment as well, so I'll touch on
Yeah, I
this
didn't
last
realise the time. Sorry about this.
No, that's okay. It's all right. I'm normally on longer, but I've got to pop out. So do you think we'll continue to see the market in 26 and beyond pricing future expectations so aggressively, especially early stage or high growth companies like the way we've seen this year? So,
I think that's a good question.
yeah.
I was going to say that I think whilst the AI build out is still in like the relatively early stages, but also a big thing for those smaller kind of companies is that the Fed rates are coming down, so they can borrow for cheaper. So I think we should see a continuation of that. Although I do think a kind of overall quality kind of element is really going to shine through. I don't think it's going to be every AI name is just going to do well this year. I think those really good ones, the ones with a USP, the ones with a clear direction of where they're going, with really high growth, with a really good leadership team, I think they can do well with the Fed rate coming down. But I don't think it might not be like anything with .ai is going to do well this year.
I think you've hit the nail on the head. I think that this year is going to be a really good year across the board. I just think it's going to be exactly the same as last year, but not in regards to how many percent we make. I think there's going to be certain points throughout the year. For instance, end of January, I don't think there'll be a government shutdown, but I think that there's going to be turmoil. There's no way to sweep through. I also think in the following weeks, because of what's been happening, what we've seen over the weekend, there's going to be some turmoil. I also think throughout the year, we'll probably see some more further tensions with China and other stuff like that, because it's not just going to all blow away overnight. So I do think that there's going to be a lot of opportunities again this year like there was last year. Whether we see the continued growth exactly like we did last year is another question, but I do think that we'll do well. But I'm going to leave on that one, boys. I will leave you boys to it.
I'll I'll end off the stream because, to be fair, like, yeah, I didn't realize it's been an hour, and I appreciate everyone.
Now, to be
watching.
fair, look,
Also,
so normally I'll stream for a lot longer when I'm on here, so it's sometimes they are a bit longer, but obviously I've got to go
Yeah.
on to my partners there still yet. So,
But honestly, guys, I'm going to finish off the stream. Thanks for everyone being involved with the stream and also watching the stream. We do streams like this on Jay's and John's YouTube, so check it out in the description. So give them a subscribe, and yeah, and also if you're interested in being with a community, DM me on Instagram and I'll get back to you on that. So yeah, anyway, appreciate it. Follow everyone in the description. I know
And
Jordan
appreciate
doesn't
everyone's
have
time
Twitter or
for that as
anything,
well.
but Jay and John subscribe to their channel because they got some good solid videos. But anyway, appreciate it. Hit the subscribe button if you're new as well, and give the video a like. So I'll see you in the next one.
Thank you, guys.
Cheers, everyone.
Thank you.